Our next session looks at the US-China trade relationship, and you really can't talk about that relationship or indeed the trade wars without first checking Twitter and seeing what the latest missive is from Donald Trump. New York Times put it really beautifully when they said that day by day, even hour by hour, his approach to the trade war with China, the most consequential economic conflict on the planet, veered back and forth, leaving much of the world with geopolitical whiplash. So far, China has imposed tariffs on some $250 billion Washington has imposed tariffs on about $250 billion of Chinese goods. Beijing has retaliated with tariffs on $110 billion of US products. New tariffs came into force on Sunday. For the first time, as we mentioned in this morning's session, those tariffs will hit consumption and consumer goods. And while it did start as a dispute over China's trade practices, it's increasingly become a geopolitical power struggle between two of the world's largest economies. And the question is, in a very bottom line sense, which man can stand the most pain? Is it the man with lifelong tenure, or is it the man who wants structural reform in China but goes to the polls in just 14 months' time? So where will it end, how will it end, and what does it all mean for super fund investment strategies? As usual, do join this conversation either via the app or we'll take questions from the floor. If you're going to put in a question, and certainly to do the poll, I'm just about to give you the poll question, you've got to choose the right room. We are in the Plenary Federation ballroom. So to get us started, the poll question for you: how long do you expect the US-China trade war to last? Now, what's not there as an option is how long is a piece of string, which I think is probably what you want to answer. But 1, 3, 5, or more than 10 years are your options there. And while you ponder that, I will introduce our speakers for this session. On my right here, Dr. Stephen Kirchner, who's Program Director Trade and Investment at the US Studies Centre at the University of Sydney. And to his right, Louisa, the Head of Greater China Equities at Schroders, who joins us from Hong Kong. So please welcome Stephen and Louisa. So, right. We're rethinking that, aren't we? 29% 1 year, 25% more than 10 years. Well, I reckon that's just a punt every which way, isn't it?
So no one knows.
That's as close as you can get to how long is a piece of string. Louisa, what do you reckon? On the money? No one knows?
That tells you no one knows, right? Yeah. My view is probably it will be a medium-term issue.
But what's your definition of medium-term?
Oh, couple years, 3 to 5 years. And trade war, my definition is not just trade war. If you're talking about more difficult China-US relationship, it will be multi-year.
What do you reckon, Stephen? Are they telling us what we knew?
Well, I think the poll results are indicative of the uncertainty that's been unleashed by the trade war, which is one of the themes of my talk, that people do not know, and that's not a good environment in which to be. My own view is this will last indefinitely, and so those who are at the sort of longer end of that poll, I think, are correct.
Well, that's depressing. On that note, we are going to allow each of our speakers to give us, they're going to speak for 15 minutes and outline their thoughts on the US-China relationship. So, Stephen, if I can invite you to kick us off.
Thank you, Ali, and thank you very much for the invitation to talk to you today. I want to focus on two mistakes that I believe many in the investment community are making in relation to US-China trade relations at the moment. The first mistake is underestimating how persistent the trade war is likely to be. And the second mistake is underestimating the economic damage that the trade war is likely to cause, and by extension, the implications for asset prices. And I think these errors explain why financial markets have been so forgiving of the trade war up until now, especially equity markets. So last week, for example, we saw a 1% rally in US equities on the back of the Trump administration saying that they had had a phone call with the Chinese about restarting trade talks. Now, it turns out that that phone call never happened, but it shows how markets will rally on even the faintest indication that this issue will be resolved. So what does that imply for markets when they are not resolved? There has been a tendency of many analysts to view the US-China trade war as a one-off dispute that will be resolved by a deal between the US and China, after which we'll all go back to normal. This assumption rests on a view that it's in the interests of both parties to reach an agreement, although that of course begs the question why the Trump administration initiated the trade war in the first place, if it's not in the administration's interests, at least as they perceive it. People often point to Trump's transactional approach and tendency to invent crises of his own making and then solve them. People suggest it's all just brinksmanship and that a deal will be struck before the 2020 election. I'm going to argue against that view on at least two grounds. First, it's a misreading of Trump's convictions on this issue, which run deep. Trump views international trade not as mutually beneficial, but as exploitation and predation, and has held this belief for more than 30 years. And he is now acting in ways that are consistent with those long-held beliefs. And so I think the best way to think about how the trade war will unfold is to assume that Trump believes what he says about trade and will act in ways that are consistent with those beliefs. If you believe trade is bad, to quote President Trump, tariffs are good and trade wars are easy to win, why would you not want less trade and more tariffs, which is exactly what we are getting. Trump only very recently acknowledged that tariffs were having a negative effect on the US economy, but now argues that this is a necessary cost that must be endured in the short term for what he believes will be long-term gains from decoupling the US and Chinese economies. If you read the US Trade Representative's Section 301 report on China, it presents an extensive inventory of US grievances against China. The US negotiating position is one that is asking China to fundamentally change the relationship between the party state and its economy. Importantly, the US is not offering to remove tariffs until China is deemed to be in compliance with US demands. And this has obviously been a huge sticking point in the negotiations. So the Section 301 report basically says that the 301 tariffs will be kept in place until such time as China's unfair trade practices, as labelled in the report, cease. President Trump is increasingly in a bind because in order to justify the damage his tariffs have wrought to the US economy, he needs to pull off a substantive deal with China. If he walks away with nothing, then the Democrats can rightly hammer him all the way home to the November 2020 election for having presided over a failed trade policy. The Chinese obviously know this and are perfectly happy to let the trade talks drag into 2020 with no intention of accepting the more far-reaching of US demands. This is not meant to suggest that China is in a particularly strong position vis-à-vis the US. China's economy is slowing, and the last thing they need right now is a trade war with the US. However, since President Xi came to power in 2012, China has been prioritising party control at the expense of economic growth, which is one of the main reasons why China has been slowing. So the Chinese will take the hit to growth rather than concede too much to the US. The politics of the dispute on both sides does not lend itself to an easy resolution, even though it would be in the interests of both sides. The other reason for thinking this dispute is likely to become a permanent feature of US-China relations is that it is somewhat independent of the Trump administration. Even before Trump assumed office, it was widely recognised that China had not evolved the way many of us had hoped before President Xi assumed power in 2012. Even if the Democrats had won in 2016, or if they win in 2020, the US was always going to recalibrate its relationship with China to reflect China's change in direction. It would have been better if the US had prosecuted its case against China through the World Trade Organization and as a member of the Trans-Pacific Partnership. But in any event, there is no doubt the US, along with the rest of the world, was eventually going to have to confront China, having collectively failed to hold China's feet to the fire of WTO rules since its accession in 2001. So the trade war is here to stay, and China has already slipped from its position as the #1 trading partner of the US. The decoupling of the US and China is underway. The second mistake is to assume that the economic fallout from the tariff is confined to the tariffs themselves, even though the tariffs represent an $86 billion tax on US consumers and business. The larger economic cost is the increase in policy uncertainty, which weighs on business investment globally, which in turn weighs on industrial production and global trade. The tariffs themselves are a second-order issue compared to the tearing up of the rules-based multilateral trading system. The Global Economic Policy Uncertainty Index has been at record highs, higher than during the GFC, 9/11, or any other shock in the history of that series going back to 1997. I published a paper in the Australian Economic Review back in March titled State of Confusion that quantifies the effect of economic policy uncertainty on global industrial production and global trade, as well as Australian macro variables, including exchange rates and interest rates. A 1 standard deviation shock to the policy uncertainty index lowers global industrial production by 0.4% and global trade by 0.6% within 6 months. We are now multiple standard deviations away from the mean on that index. For Australia, the good news is financial markets carry the burden of adjustment, so the real effective exchange rate declines by 1% and the real 3-year bond yield declines by 20 basis points, which is pretty consistent with what we have seen recently. The way to analyse the effects of the trade war is through the lens of policy uncertainty. And if that is not a feature of your macro models, you are not going to see the fallout from the trade war until it shows up in the macro data, by which time it is all over from an asset pricing perspective. Even without the trade war, the world was facing a cyclical slowdown coming out of China. The trade war simply adds further momentum to that downturn and is enough to push the global economy into recession, a recession President Trump will now own, regardless of the deals he does from this point. So from an asset allocation perspective, I'm somewhat reluctant to tell a room full of fund managers how they should do their job, but I'll tell you what I see in terms of asset prices, and you can grill me later as to why I argue this is the case. So US dollar denominated fixed income assets I think will do particularly well in this environment. That's partly a monetary policy story as much as a trade war story. The Australian dollar exchange rate will carry the burden of adjustment for us, so I would not worry about hedging offshore exposures at this point. I would position for an uplift in the A dollar value of offshore assets. The RBA will drag the chain in responding to the downturn and will ultimately have to move much more aggressively than it has done to date. So getting out in front of the RBA is also a good idea. I have a United States Study Centre report on lessons from the US experience with quantitative easing for Australia that I would commend to you if you want to understand how QE is likely to work here. For equity exposures, I would favour low vol stocks, notwithstanding the fact that I like low vol equity anyway. I don't think long-short equity will have much value in navigating the trade war. Its implications are too broadly based for that to work effectively. If you allocate geographically, I would also underweight China, given the party state in China will have to sacrifice increasingly economic growth in order to maintain control, not least in light of developments in Hong Kong. The dilemma for the Chinese Communist Party is that the more they sacrifice growth to maintain control by the party state, the further they delegitimate themselves, requiring even further controls. So this has the potential to become a downward spiral that will see investors increasingly reevaluate the China growth story going forward. So I'm happy to elaborate on what I see as the asset price implications of all this during the Q&A, as well as the macro implications. Thank you very much.
Thank you very much. Thank you, Louisa. Can you be hopefully more chirpy than Stephen?
Good afternoon, ladies and gentlemen. This is my first time in Tasmania. Beautiful city, unfortunately, to discuss such a depressing conversation. First of all, looking at my slide, I have to say Mr. Chum has been sort of flip-flop faster than I can update my chart. So that chart is still based on 25% tariff. On number-wise, the first direct impact of the trade friction and the tariff imposed is quite simple. Basically, roughly, assuming 25%, you are looking at roughly GDP, the export to US as percentage GDP, roughly about 4.5% of China GDP, and the impact is roughly 1.1%. So that actually is quite easy to quantify. But unfortunately, I think that one actually, if you look at the government policy response, and this probably has already taken into consideration. But unfortunately, it is really the secondary impact and the tertiary impact, which is more difficult to quantify. I've been asking quite a lot of economists, strategists in China, can you give me a number? Most of them say, oh, wait and see, I have no number for you. So I haven't really come up with a number, but that would be a multi-year implication. The first one actually is on investment. So capacity, expansion plan, CapEx program, a lot has been delayed. Because as an investor, you don't know your client, what they think, and you don't know how to tackle this type of flip-flop situation. So for the company we have met since last year, we've been on that conversation with them regularly. Most of them, basically, whoever have a plant in ASEAN market, Vietnam, Cambodia, they are ramping up as quickly as possible and ship stuff from that to the US. But however, a lot of their clients don't know what's going on. So basically, decision in China has been standstill, and they are doing quite a lot of feasibility study. So that actually significant impact on the near-term investment CapEx program for a lot of private companies. And apart from that, unemployment is also a secondary impact. The number I've seen, basically, if assuming just a direct impact, export company to the US, is probably 1.5 million to 2 million people, not that much. But that doesn't take into consideration a medium-term impact, which is maybe relocation in future, shutting of the factory in China. The last one is consumption. So far, we haven't really seen much of that impact. But if the situation deteriorates further, I believe this would actually impact on the economy in the next 3 to 5 years' time. Again, when we look at the actual impact to profitability and the impact to the economy, the first two batches of the goods being put on tariff, most of them actually are raw material, capital goods. When we talked to the company last year, when they put on the 10% tariff, most actually basically say, oh, I'll take 5, and my client take 5, net. So we will sort of absorb it. But now when it is 25%, and then the last batch of the goods, a lot of them are consumption goods, are consumer goods, and your Christmas shopping list basically are delayed to December now. So that is your Apple handset, your toys, your shoes, your clothes. When you have a company in China which making single-digit margin, there's no way they can absorb that. And even Walmart, I'm not even sure Apple want to absorb that 25%. So most of this eventually would need to pass through to the consumer. That would have impact to the US consumer demand, consumption demand, and inflation. So those are the things we are yet to be seen if there's no improvement from the trade relationship. Export this year, you see the blue line and the green line basically are the first two batches of goods. Last year, export to the US is up 11%, reflecting a lot of inventory build, front load because of tariff implementation. And this year, these two badges are year to July down 20-30%. And year to July, export to the US is down 8%. But more interesting is you look at the export, import from China from US is down 28%. So net, most of those are agricultural stuff and some of the intermediate goods. So net, basically, you see no improvement in the trade numbers. However, we probably are aware that at the end of the day, you look at the trade deficit for the US, that definitely no improvement. The only improvement, the only changes basically is the composition of the breakdowns. So China, year to date, as a percentage of the trade deficit, basically moved from 48% to 45%, where Vietnam and Taiwan actually gone up from 13.6% to 16%. So that tells you, this trade relationship doesn't really create jobs or help anyone. My view is always the trade tension, which should happen probably, all the complaints from the US probably should happen 10 years ago. But it's a little bit late addressing it now. If you look at the trade fiction, at the end of the day, my view is always it is not really that much about trade. And it is really about vying for the technology and economic leadership for the next 2 decades. A lot of things where Stephen has captured in his speech. You look at the technology side, obviously there's another tension there. And that actually, I don't think you will be removed anytime soon. If you look at Huawei situation, first of all, from a near-term impact, you will have a big impact to the electronic demand in the electronic cycle. It is a $100 billion US sales company. 20% of handset global market share, 30-40% of your telecom equipment market. So a restriction to some of the component to them will impact on some of the US company sales. At the same time, you would actually damage quite a lot of consumption demand. This incident, the way I look at it, is further increased or give the China government the determination that they need to build their own capability in the upstream electronic value chain industry. So what we have seen is a lot of money is or will be flowed into building your DRAM factories, your IC given to IC design house, manufacturing companies. So this is another area I think would see more impact to the economy going forward. The next phase of it, actually interesting, not that many people talk about, but increasingly we are starting to hear more noises on the financial side. So there has been more criticism of pension, US pension investing in China stock. So I think into the next 12 months, you might hear more noises from that. Personally, I do not expect that would be the same as the Russian situation where you are restricted to going to the bond market or restricted for investing in some of their stocks. But you definitely will hear more noises there. Government policy response. As we see, there are definitely a lot of challenge heading ahead. And from the last few months, talking to the government and talking government officials, and from what Mr. Xi's comment, prepare for a long march. I think that is exactly what the implication. They are here and prepare for relatively long tension going forward. You've looked at the short-term policy response, there's quite a lot on it. In year 2018, they went through a period of deleveraging. And because the escalation of tension, trade tension, some of these are put aside. Now we are looking at a more accommodative monetary policy. We are looking at potentially, you still got room to cut reserve requirement ratio. Recently, a month ago, they talk about interest rate reform, which is adjust the LPR, basically the intention is to pass on cheaper money and lower interest burden to the corporates. And the physical side, there has been a package, almost 2 trillion package announced, RMB announced. That's more than 2% of the GDP. To some extent, probably it's also to help to ease off some of the trade impact to the economy, that including the income tax, household income tax reduction, VAT tax cut for the corporate, and reduction in also some of the fees. The next phase we probably are going to see in the last couple of days, there's also some sign from the news, is the fiscal stimulation. At the end of the day, if this trade tension escalate further, and if the damage or to the economy is getting worse, you would be expecting to see more special purpose loan to be announced and more stimulation to the economy. And the other one, quite obviously, they're going ahead quite aggressively, the 5G investment. Longer term, we are seeing, so that part is probably sort of medium to long-term responses, which is yet to be monitored. But quite obviously, they are continuing to open up their financial market. For foreigner, now we can, from 2020, we can actually have a majority stake to a local financial institution. Definitely, Schroders interest and quite a lot of competitors are looking into it as an opportunity. And then they continue to open up the bond market, the connect, the investment into domestic Asia to attract foreign capital into the market. So some of this actually is a bit early. It's yet to be seen, but if the situation is getting worse, you would see probably more government policy response, stimulate the economy, stimulate consumption, etc. I think I probably stop there on the trade. It's pretty depressing talk. It would be a bigger struggle that at the end of the day, like Steve said, will end up with a slower economy in China. Probably not just China. I would be expecting to be impacting to the global economy. However, one thing that we probably make it more interesting, maybe we focus on China as an opportunity, a risk and opportunity. From an opportunity set, this is one market is still underrepresented in your global indexes. US is 25% GDP, 55% of MSCI China index. And it is actually 214% market capitalization over GDP. For China, it is 15%, 60% of global GDP, 3.7% of the index, much smaller than Japan, and between 60 to 100 of the market cap over GDP. I think looking forward, it is likely this type of opportunity, you'll see as the market opening up, more foreign attract into the domestic market, this proportion would go up rather than going down. And the Connect system, which they launched in 2014 and 2016, was a game changer. You do see continued money to go into domestic market. Year to date, despite all these noises about trade, economic slowdown, domestic Asia market still up 28%. I know Australian market has done very well as well. So I think there's still an opportunity which people would look into it. From an active investor point of view, I find it quite exciting, quite interesting. So by the end of the year, MSCI index, the emerging market index, the domestic Asia market actually will move from 80 basis points to 3.3, which is quite big, quite a lot bigger than quite a lot of ASEAN market. The other thing actually making it interesting is this market, domestic Asian market, is very low correlation with the other world market. As we all know, it is still a pretty close market. As I mentioned, from an equity active investor, I've been investing in that market quite a few years. This actually opened up quite a lot of opportunity set, offer opportunity for active investor. If you look at the correlation, even the domestic Asian market, its correlation with MSCI China is only 0.56. We have done some work. This is a chart given to me by our GEM team, basically saying by adding the domestic Asian market, it does improve your portfolio inflation frontier. Valuation is still reasonable if you compare to historic range and compare to developed market. However, as an equity investor, in this time more challenged environment, as Steve say, it is going to see a low return, probably negative interest rate in many places. How we position our portfolio actually is also quite challenges. What we are doing right at the moment as an equity investor, we are just doing equity, right, my background. So we actually run a more barbell strategy. On one hand, we have a big of dividend yield focus in a low return environment and also gold exposure. Basically saying, the volatility, the political tension. On the other hand, we basically more focus on the industry, which we like, and structurally, we can see positive growth over the next few years. That include pharmaceutical industry, consumption, stable and discretionary. You do have 400 million millennials, the young people who are happy spender than their parents. And then we're also looking at the green energy and a couple of very selective TMT stocks. So I think maybe I'll just stop there, given my time's up. So, and we can leave some time for Q&A, further discussion on the topics you want to. Okay, thank you.
Thank you, Louisa. So do, as many of you have already, do send your questions via the app. I just want to, obviously, Louisa, before we get to Louisa's more optimistic view of the other opportunities in China, Stephen, I just want to ask you, what's the end game, do you think, in this bilateral relationship? And what does decoupling actually look like at its end point?
Well, this is part of the problem, that there is no end game. And Trump initiated the trade war with the rest of the world without thinking through what the off-ramps might be and how these things might be resolved. So, I think it's better to look at this as sort of an ongoing process in US-China relations rather than something that's heading towards some inevitable sort of endpoint.
But I guess the inevitable endpoint is, it's almost like they're going to kill each other eventually on an economic front, if the picture you paint is right. I mean, you're talking about a diabolical outlook, not just for the US, but for the global economy. I mean, that's an ever-diminishing situation, isn't it?
Yes, when I talk about decoupling, obviously you can't completely decouple the Chinese and US economies without doing enormous damage to both. So it's a question of magnitude, and I don't think anyone has a clear view as to where the US and China land in terms of this process, other than to point out that this is the direction in which they're going. I think the decoupling will be partly on the trade front, will also be on the investment front. I think you'll see it increasingly in terms of the ICT sector. So I think it's likely that the global internet infrastructure will fragment. We'll see it in the telco sector as well. So you'll get a fragmentation of telco standards around two competing systems for 5G. And the internet will be increasingly balkanized as well. So if you think of trade in terms of digital services, something that was seen as having enormous upside, I think will increasingly come under the gun in terms of US-China trade tensions.
And can I ask you made the comment that this is now beyond Trump and that this will continue even if Trump doesn't. What gives you confidence about that? I mean, not just looking at the history, but if and I'll ask Louisa about this in a minute, but if China can withstand this and doesn't buy soybeans and doesn't buy this and doesn't buy that, and Trump is thrown out, big call at this point, but where is the impetus going to be for a new government to continue to pursue it?
Well, if you look at what the Democrats have been saying, you won't find any Democrats criticising Trump's tariffs. They are completely MIA on that issue. What they do criticise Trump for is failing to secure a deal with China. There is a consensus across US politics, a bipartisan consensus, that something needs to be done about China. I think the US feels that the previous administrations have failed to hold China to the standards that were set for them when China acceded to the WTO. And this is a very broad consensus in Washington. It's in the business community, it's pretty much across the board.
And when consumers can't afford to buy anything, when people in the agricultural sector lose their jobs, when those key Wisconsin, Michigan and Pennsylvania, which have got so many farms, are in deep, deep trouble, does that political resolve hold?
I think this is all a huge problem for Trump, and to the extent that there's a severe downturn in the US, I think he will have a lot of trouble not owning that downturn. And it could well see him out of office. But the question is, who replaces him and what do they do? The Democrats are, if anything, even more anti-free trade than the Republicans at this point. If you look to take one candidate, Elizabeth Warren, she has argued in favour of the US intervening in foreign exchange markets to manipulate the exchange rate to counteract trade imbalances with the rest of the world, and most notably China. I don't think that will work, but if that's the sort of policy that they're going to bring to bear, then that's a recipe for huge volatility in financial markets, and points to the fact that the trade concerns are not going to go away with President Trump.
Louisa, you made the point that you don't think this is necessarily about trade, and if you look at the long list which you referred to, Stephen, of changes that the US wants, essentially you can argue that they do go to the heart of the party's control of the economy. Things like its market access, industrial subsidies, intellectual property, transfers of technology. Is there any appetite in China on behalf of Xi Jinping to give any ground on this, or not? I can't think of another way.
It's quite tricky. My view is always it doesn't go from point A to point B. So there's a lot of discussion behind the scene. I think from China point of view, first of all, some of this actually can compromise, some cannot. Bio soybean and then sort of some IP protection, this is correct, legitimate. And probably US is 10 years too late to do that anyway. A lot of this technology already absorbed and developed their own technology, like what you see in railway, etc. But if there are certain things which go direct to the legitimacy of the party, there's no way they're going to do. So my view is always, you could come up with some patch deal. So at the end of the day, when there's sufficient pain, I think on the political front, you will have some compromise. In the US, if you suddenly inflation go ballistic, you're running the Apple, and you don't have Apple, I think there would be pressure. You have already started to see some pressure from different corporates. They all have vested interests. Politicians have vested interests. Company have vested interests. There will be noises coming through. This is why I think it is making it very difficult. Is I could see some sort of compromise and say, okay, let's not 30%, do 10% or whatever. It could be rich, but the longer term tension, especially on the technology side, will still be there. And the only thing is, if you go to the ultimate reform restructuring, if you touch, as I mentioned, the legitimacy of the party, there's a line, some of the things cannot be done. Yeah.
So even you talked about how China is punching well below its weight with the MSCI. Do you still think, though, that with all that uncertainty, it is a good time to invest? I mean, regardless of the opportunities, you're dealing in a market where risk is really immeasurable at this point.
Invest in China. I joined Schroders 96, 20 plus years. I've been for all period cycle, basically say China will go, the system will disappear, the banking system will go bankrupt. Within Schroders, we had a lot of debate, but it does matter through. So my view actually is, obviously, there is risk, there's opportunity set, and it is second largest economy. I do think sometimes being contrarian, you can make money from that. The other thing, actually, going back to the previous question, I just thought about it. Another thing is, from China's point of view, it's also quite interesting. Do you really want to negotiate with Trump? And what you negotiate or the deal you've done, would that be honored? So whether they should wait.
And they can wait it out. I should say I was a Beijing-based China correspondent in the very early 90s, and I think since then people have been telling me that the Chinese economy is going to collapse at some point, and it consistently defies those predictions. Can I ask Stephen about the impact on Australia? And I was speaking to someone who is, has successfully, but on a small scale, broken into the Chinese market with shoes. And they have a couple of manufacturers there. And he was saying that the collateral damage is that the factories they rely on actually rely on US contracts for the bulk of their earnings. And so if the trade dispute gets worse, those factories shut down because we can't sustain them. So that's just one example of potential collateral damage. That's a negative, but then there's also, I assume, positives.
For Australia's economy as a whole, I think that what you're pointing to is the fact that global supply chains are being disrupted, and it becomes very hard to predict what the ripple effects of that will be. I think if you're anyone who's in a position of making business investment decisions at the moment has to be very careful, because even if you try and route around the tariffs, there's nothing to say that the US won't revisit tariffs on other countries as well. So, for example, Vietnam is said to be a major beneficiary of the trade war because a lot of manufacturers are relocating from China to Vietnam to escape the tariffs. But of course, there's no reason why Vietnam can't be hit with tariffs at some point in the future. I mean, it's a authoritarian communist state, doesn't have the best relationship with the United States. Does this sound familiar?
Nor China, it should be said.
Yeah. And so Australia's in the same position. So you'll recall that Australia was exempted from the steel and aluminium tariffs. Not surprisingly, we saw a trade diversion effect where there was a huge increase, I think 30% increase in Australian aluminium exports to the United States because all of a sudden we were much more competitive. Trump saw that and wanted to slap tariffs on Australia. And it was only the intervention of the State Department and the Pentagon that prevented that from happening. So they said, do you really want to do this to your closest ally? And that argument won the day again. So I think the idea that you can route around the tariffs is increasingly unlikely. So what does this do from a business investment point of view? It raises the option value of investment, which means that you basically don't invest. And we're seeing an investment strike globally, including in Australia. So Josh Frydenberg was out the other day sort of pleading with business to invest. But in the current environment, you could well understand why a business would be reluctant to do that. So I think the biggest casualty here is investment that has flow-on effects to trade and growth. We're seeing that in Australia, we're seeing it globally. So I think it's very hard to avoid that implication.
And just before I go to questions, Louisa, if I can ask you about, of course, the other great elephant in the room, which is Hong Kong. We've seen already a very big impact on the sort of investment environment there. You're an equities strategist. How do you see the future with what's going on in Hong Kong? And particularly, is it a place now that from an investment point of view, one just puts to one side?
As a Hong Kong people, it's rather sad to see what's happening right now, quite a challenge. I think from an investment point of view, Hong Kong near term still has its place. The way I look at it is, as long as China still holds its as a closed capital market and with a different legal system, Hong Kong still have its usefulness. You still got a value attached there. But medium to longer term, Hong Kong itself has been changing. For example, in my team, we used to be a whole team of Hong Kong graduate, overseas educated. Now we have a very diverse team, people from mainland Chinese and some very grassroots sort of analysts. So the compositions have changed. If you go to a Pacific place, most people actually in the lift talks Mandarin now. 20 years ago, it's Cantonese. However, I think longer term, Hong Kong will be absorbed somehow into the greater Bay Area, because at the same time, China is developing Shenzhen, and it is 22 million people in that greater Bay Area versus sometimes 6-7 million people, Hong Kong 6-7 million people. So longer term, I do see, the development in Shanghai, development in Shenzhen would be a competing force medium term. So from that sense, you are looking at medium, longer term, Hong Kong probably is one of the cities.
Of course, as Louisa said, it is absolutely tragic what's going on there. Stephen, from a political point of view, it is hard to understand the end game, given we come to 2047 when one country, two systems will no longer exist. What do you think is going to happen?
Yeah, I mean, it's interesting from the Trump administration's point of view that Trump has given almost no rhetorical support to the protesters in Hong Kong.
He made one comment early on, didn't he? And then he...
Yeah. But by the same token, he has also been tempted to link this to the trade issue as well. And historically, the US did link trade and human rights issues up until the Clinton administration. And then they sort of put that to one side as being awkward. So it's a little difficult to see how these issues are going to intersect. I mean, this is a policy choice that the US is going to have to make, and I'm not sure where the Trump administration is going to land on this exactly. But I'm very fearful of what is going to happen in Hong Kong, because President Xi is a very ruthless individual. He has suppressed his opponents in China. He has crushed the economic liberals. I think the lesson he has taken away from the experience of 1989 was that the regimes in Eastern Europe that tolerated dissent are no longer with us. The regimes that crush dissent still are. So he will take that lesson to heart, and I fear that there will be a crackdown in Hong Kong, and Hong Kong will basically no longer function as the sort of international financial centre that it has.
And of course, it's less important as an international financial centre than, say, it was 10 years ago.
But I think this is an issue for China as well. I mean, there's a structural slowing in the Chinese economy. You'd expect this as the economy matures. You've got this overlay of increasing authoritarianism and a return to central planning that will also slow the Chinese economy. And from an investment point of view, I mean, regardless of what you think of China's prospects, what I'm seeing increasingly from people outside of China is a reluctance to even travel to China because of concerns over their own personal safety. So if you're not prepared to travel there because you fear that you might be arrested and used as leverage in a trade conflict, then how keen are you to invest there given the uncertainties about security of property rights, rule of law and so on?
A couple of questions from the app, so please do put your questions through, or indeed pop your hand up and we'll get a microphone to you. Louisa, I'll give this one to you to start with, and we can tic-tac between the two. Is the trade war now a currency war? And what does that mean for Australia? I don't know whether Stephen can pick that bit up. Is it a currency war?
No, I don't think trade war is a currency war. First of all, the currency itself is a closed capital market. It is really meant to throw against a basket. So if you look at in the last few incidents, when 2007 and then the previous great financial crisis time, China has been holding up the currency quite well against the other currency. If you look at it, over the period, it actually appreciate. A lot of times, currency is relative to what happened. We see the British pound and the euros. Two things. Medium term, I do expect. First of all, two things. First of all, currency stability is quite important for them because they still got the ambition to make RMB as slowly sort of RMB internationalization. So that actually, if you do, I also want to attract foreign capital into the market, FDI. So if you have very weak currency, it is not the way to go. The other thing actually is compared to in the past, it is very export-oriented, manufacturing-oriented sort of economy. It is becoming less reliant on that part of it. And they do want to move up the value ladder. So from that sense, it also doesn't justify to have a very weak currency. The last one, actually, the reason why I say slowly over time, I would be expecting a depreciation, a moderate depreciation of the currency. It is also reflecting that if you look at the last 4 or 5 years, the reserve is relatively static, about 3 trillion. But if you look at monetary base, you do see an increase in the base money. So that actually naturally gives them some depreciation pressure over the period. But for that number, if you look at the total exposure, the speed they could go up, it probably compared to a lot of developed markets, it's not that bad. The other thing actually, I always think RMB compared to other emerging market currency, it is not as vulnerable. The key reason actually is because they don't have a lot of external liability. They actually probably have more external asset and liability. So you probably are not expecting sort of Asian crisis, Argentina sort of styles, pressure coming through the RMB.
Australia, the impact on Australia there?
Well, if I can speak to the whole currency war issue first, I mean, there's no doubt that if China had a floating exchange rate, it would depreciate dramatically on the back of market forces. And that's not currency manipulation in any way, shape or form. That's just accommodating what the market wants, which I think what China's been doing. So they've been leaning against the depreciation. A floating exchange rate would serve China very well at the moment because, of course, once you float, then you're no longer worried about capital flight because you can't speculate against a floating exchange rate in the same way that you can speculate against a fixed exchange rate. China won't do that because they experimented with a more market-determined exchange rate between August 2015 and January 2016, and the Politburo did not like the volatility that came with that. I mean, it's normal volatility from the point of view of our FX market, but the leadership in China views volatility as basically equivalent to disorder, and they don't like disorder. So it would make perfect sense for China's exchange rate to depreciate to neutralise the tariffs. They will have to accommodate those market forces at least to some extent. I mean, all managed exchange rate regimes only succeed to the extent that they accommodate economic fundamentals. So they'll have to do that. This is not a currency war or currency manipulation. This is just recognising the reality of this situation. Some people talk about monetary policy as being a sort of vehicle for a currency war, a sort of beggar thy neighbour depreciation. But if you've got a floating exchange rate and monetary policy is targeting domestic inflation, the exchange rate will do what it has to do. And for Australia, I think that certainly means depreciation. The floating exchange rate has always been our get-out-of-jail-free card in respect of external shocks. I suspect it will serve that function this time around. But there's nothing insidious about that. It's a market-determined relative price, and it's just performing the function that we want it to perform.
Another question here from the app. China is the world's largest producer of rare earth materials. Will China stockpile its rare earths to punish the US, even if it hurts other trade partners? Louisa, I know you're an equities person, but...
We don't invest in rare earth to start with. I think they did talk about it. It's one of the cards. The reality, I think at the end of the day, I would say, if you look at a lot of things they have done throughout the trade war period, I would say relatively they are quite restrained or refrained from being very aggressive. Even their involvement in Hong Kong, they are quite refrained, trying to behave more like a good global citizen. So from that point of view, I think it is one of the counteract, but I'm not expecting, it really depends on what the US and how far they go. And then I'm hoping it will not escalate.
Gosh, if they really wanted to escalate it, they could just dump the $3.whatever trillion in foreign currency holdings that they've got, couldn't they?
No, they have not done that so far.
I'm saying
it is one other thing, right? They hold quite a lot of U.S. Treasury bill, because from the whole interaction so far, you heard more noise from the U.S. part, and they have been relatively sort of sit still and then say, okay, what are your sort of complaint and all this? We try to accommodate, because you definitely see more treater from Trump than the response from China. The only thing they have been doing is they do actually show you some picture of where Earth and all these things, but so far, I think they have been relatively framed, because from that sense, being very aggressive are not doing them any good. I hope they still keep that sense.
Question here that if the US-China trade dispute is going to continue for more than 5 years, and if both, I'm not quite sure what this says, but I think what they're getting at is that if it continues, if the trade war continues for a long time, and Australia has to pick a side, whose side do we pick, Stephen? Now, here's the age-old question.
Well, I don't think it really comes down to being forced to pick a side. I mean, where that choice might be forced is in the event of an armed conflict between the US and China.
Seriously, how high do you rate the chances of that?
Well, so not particularly highly at the moment, but I think that's the only situation in which we'd be really forced to choose. You have to remember that trade between Australia and China is mutually beneficial, so if China tries to coerce us economically, that's a cost to them as well. But more importantly, I think any attempt by China to coerce Australia economically would drive us closer to the United States, which would be counterproductive from their point of view. I'm not making a prediction as to exactly how that would work. But I think from a security point of view, we have no choice but to be allied to the United States. The alternative is armed neutrality, and as Hugh White has frequently highlighted, the cost of Australia being going down the armed neutrality route is so high it would negate any benefit we might get from increased trade with China.
Just a last question, we're almost out of time, but Louisa, do you think the alpha opportunities will decrease over time as China goes higher in the index and more managers manage their exposure?
So far, if you look at investment in Asia, domestic Asian market, and definitely is one area you can quite easily generate alpha. And the other market is India. That reflecting the nature of the benchmark and also very long tail structure. And the other thing, quite obviously, it is still emerging market. You still have a lot of inefficiency. That question is being posed to me very often, regularly. But in near term, I don't think, because 80% of the market is retail, 3% are foreign institutions. The rest of the local institutions, to some extent, they also behave like retails. So there's still a long way to go before the market would be efficient. So I think from our point of view, if there's one message you can go and remember is if you do want to go for China, go active rather than passive.
Go active and be prepared for a very long march, I think, is the way we have to think about this trade war. Please join me in thanking our guests very much, Stephen Kirchner and Louisa Lowe. Thank you.